Okay, so we are jumping straight in today. I mean, right into the deep end of corporate strategy. This is a massive deep dive.
It really is. We're looking at hundreds of pages of disclosures here.
We are cracking open the 2021 annual and ESG reports of a global beverage leader. You know, the one, they sell 1 out of every 4 beers on the planet.
And our mission really is to distill all of that noise, to pull out the most material, the highest impact insights on their performance, their digital journey, and where they're headed.
Exactly. We want the shortcut to being well-informed. How did this behemoth navigate 2021, and what path do they lock in for the future? So let's set the stage, the macro context.
The context is everything. 2021 wasn't just a simple bounce-back year. Not by a long shot. It was defined by, well, this dual challenge, right?
All right.
Navigating the ongoing pandemic environment, which was still just wrecking supply chains and hospitality.
Still so much disruption.
Exactly. And at the same time, accelerating these huge long-term strategic shifts. So I think the key takeaway right up front is that this company, despite all that, achieved really robust financial health and made a very clear, very definitive push into high tech.
Okay, so let's start with that performance. The scale is just immense. Despite all the global volatility, they managed, what, 9.6% overall volume growth?
Yeah, 9.6%, pushing them up to 581.7 million hectoliters.
Just to put that into context for you, a hectoliter is 100 liters. It's a truly staggering amount of liquid.
And that operational growth, it went straight to the bottom line. Normalized EBITDA, basically a measure of their operating profit, hit $19.2 billion. That's 11.8% organic growth.
So people weren't just buying more.
No, it tells you they had pricing power, which in an inflationary environment is absolutely critical.
For me, though, the real insight wasn't just the growth. It was the financial discipline. They got really focused on the balance sheet.
Oh, massively.
Yeah.
A $10 billion reduction of gross debt in 1 year.
10 billion.
Yeah. That is a huge statement. That kind of deleveraging, it signals to the market that capital structure, getting their house in order, that's the #1 priority. Way over aggressive M&A or big dividends.
And 2021 was also the year they kind of formally laid out their new strategy, right?
Yeah.
These 3 pillars that really redefine who they are.
Precisely. They're telling the market, look, we are more than just a brewer. The 3 pillars are, first, letting grow the category, so core beer, but pushing for premium.
Okay.
Second, digitize and monetize our ecosystem. That's the big tech play. And third, optimize our business, which is that financial discipline we were just talking about.
So they're moving from being a traditional CPG giant into, what, a tech-enabled ecosystem?
Well, that's the goal. That's the whole story.
That all sounds great on paper, but, you know, huge revenue growth always hides some pressure points. Where did the headwinds actually show up?
Well, the biggest one, kind of hiding in plain sight in those reports, is margin compression at scale.
So they're making more money, but keeping less of it.
In a way, yes. While revenue was climbing, their global normalized EBITDA margin, it actually contracted by 118 basis points. It fell to 35.4%, so that's just over a 1 percentage point drop in profitability.
And I'm guessing that wasn't spread evenly across the globe.
Not at all. North America saw a 160 basis point contraction. The report says that was mainly due to higher SG&A expenses, so marketing, logistics, that kind of thing.
Okay, spending more to sell.
Right. But the really sharp hit was in South America, a severe 401 basis point margin contraction there.
Whoa, 4 percentage points. But wait, didn't that region have fantastic revenue growth, something like 26%?
It did, 26.3% revenue growth.
So if revenue's up by a quarter, but margins are down 4 points, are they just chasing volume at any cost? I mean, is that sustainable?
That is the critical question the numbers raise. You know, the report implies they were fighting huge cost pressures, inflation, chaotic logistics, maybe taxes, and they made a choice. They chose to chase growth and market share and just accepted a short-term hit to profitability. It paints a picture of a very tough, very competitive market down there.
Okay, challenge 2 was the pandemic. It was still very much a factor. They kept mentioning the ongoing challenging environment.
Yeah, that's a necessary cost, isn't it? It's an operational drain, but you have to do it to maintain your social license to operate. All the community support, the mask donations, helping out the hospitality sector.
And the third challenge,
Yeah.
this one raises some questions about their strategy, their non-alcoholic and low-alcohol pure portfolio.
Right, the NABLAB portfolio. They have this really ambitious goal for it to be 20% of their total volume by 2025.
And how's that going? I heard the revenue growth was good.
It was double-digit revenue growth. Brands like Budweiser Zero, Stella 0.0, they're doing well, but, and this is a big but, They state very clearly in the report that they are not on track to meet that 20% volume goal.
Ah, so there's a disconnect.
A major one. The
Wow.
revenue growth is there, but they're not shifting the actual volume mix fast enough. It shows how reliant they still are on traditional beer, which makes that whole diversification effort much, much harder.
Okay, let's flip this. Let's talk about the big strategic wins. If the challenges were margin pressure and the non-alc miss, the big investments were all about pivoting the entire infrastructure. The company is, well, it's rapidly becoming a high-tech platform.
Absolutely. And the biggest event has to be the sheer scale of their digital transformation, specifically the B2B platform, BES.
This is more than just an ordering app, right?
So much more. It's the new digital nervous system for their entire global distribution. In 2021, BES hit 2.5 million monthly active users. It processed 78 million orders, and it clocked 20 billion in gross merchandise value, GMV.
And GMV, just so you know, is the total value of everything sold through the platform, so that 20 billion figure is just massive.
It's incredible, and they highlighted that over 50% of their global revenue now flows through these digital platforms.
Wow.
It completely digitizes their relationship with 6 million customers. And then you have the direct-to-consumer side, Zed Delivery, which did 67 million orders, more than doubling its 2020 volume. The speed of adoption is just phenomenal.
But doesn't that create a huge risk? I mean, if 50% of your revenue runs through your own platform, what happens if that system goes down? Or if regulators decide it's anti-competitive?
And that is precisely the risk they now have to manage. The upside is huge efficiency, data, a competitive moat. The downside is that reliance on their own tech and, yes, potential regulatory scrutiny. It's a calculated bet on market domination.
Okay, key event number 2. This comes right from that first strategic pillar. Doubling down on premium brands and innovation.
And this is working. The focus on moving consumers up the price ladder is really paying off. Their premium and super premium brands grew over 20% and now make up about a third of total revenue.
So people are willing to pay more.
They absolutely are. And critically, they're global brands. So think Budweiser, Stella Artois, Corona grew 23% outside of their home markets. That's key because that's where they can charge the highest premium.
They also had that core innovation success with the double malt concept.
Yes, rolled out across 12 brands in 10 markets. And that one innovation brought in over $450 million in revenue. That's an incredible return on R&D.
Now, this is where I think it gets really interesting. The third key event, their strategic move into biotech.
Yes, the formal launch of BioBrew and Evergreen. They're leveraging their core expertise in fermentation, but for things that aren't beer.
Explain why that's so important strategically.
Well, think about their assets. They own some of the biggest, most sophisticated fermentation tanks in the world. They're now using that infrastructure, which was only ever for beer, to make totally new, high-margin products. Evergreen, for instance, is aimed at the animal-free protein market.
That's a huge market.
Estimated to be worth $22 billion by 2035. They're turning spent brewing grains into high-value ingredients. BioBrew is the platform for other ventures, like scaling up production of animal-free egg protein. They're using their existing assets to tackle the global food challenge. It's a brilliant pivot.
Let's shift gears to ESG. The reports make it really clear this isn't just a sidebar. It's tied directly to their core strategy.
On the E, for environmental, we're seeing real action. 74.5% of their products are now in returnable or majority recycled packaging. That's a tangible, measurable win.
I also saw they piloted the world's lightest long-neck glass bottle.
Yeah, cutting CO2 emissions by an estimated 17% per bottle. And when you operate at their scale, small changes like that add up incredibly fast.
What about the big long-term commitments? And are there any, limitations or catches?
The big one is net zero carbon across their entire value chain by 2040. Hugely ambitious. But here's the tension point. They have 81.4% of their purchased electricity contracted from renewable sources.
Okay, that sounds great.
But only 39.9% of that is currently operational.
So less than half of the clean energy they've signed up for is actually powering their breweries right now.
Yeah.
Why does that gap matter?
Because contracted power is a promise. Operational power is reality. That gap exposes them to risk price volatility, project delays, regulatory changes. It really highlights the difference between strategic intent and the speed of execution.
Okay, moving to S for social. The focus here seems to be on strengthening their value chain, starting with the farmers.
Yes, and this is about long-term resilience. They work directly with over 22,000 farmers, and they gave specific metrics. 74% are skilled, 65% are digitally connected, and 69% are financially empowered. This is how you address climate risk at the source.
And it goes beyond the farm, too. I saw they trained over 6,000 small retailers in Peru. That's not charity, that's just good business. You're strengthening your own distribution network.
Exactly. Then, finally, on G for governance, they appointed a dedicated chief sustainability officer who reports right to the CEO. That tells you ESG is a boardroom priority now. They also started integrating human rights risks into their supplier management process, engaging with suppliers that represent over 30% of their global spend.
Okay, so looking ahead, given how turbulent 2021 was, what are the most critical priorities for the immediate future?
Priority one, and it underpins everything else, is aggressive deleveraging. They're doubling down on debt repayment. The goal is to get their net debt to EBITDA ratio to around 2x. Financial stability first.
And priority 2 is scaling up those new ventures.
Exactly. On the digital side, continue scaling the bees ecosystem globally. And on the biotech side, the big milestone is getting the St. Louis Evergreen facility for sustainable protein fully online in 2022.
That's the key, right? Moving from a pilot project to full-scale manufacturing.
That's the moment the pivot becomes real. And the third priority connects right back to the core business.
Which is?
Post-pandemic activation. Simply put, it's about activating consumer demand as bars, restaurants, and big events come back. They need to capitalize on that recovery to fund everything else.
So what does this all mean for you? We've gone from basis points in South America to biotech in St. Louis. Let's boil it down to the 3 most important takeaways.
Okay, takeaway 1, the digital gateway. This company has successfully pivoted from being just a physical distributor to running a massive digital ecosystem. BEEs and Zed delivery aren't just tools, they are the primary drivers of growth now.
Takeaway 2, premiumization power. Yes, volume growth was strong, but the real value growth came from consumers trading up. That focus on premium and super premium is how they're offsetting inflation and capturing more value.
And takeaway 3, future-proofing the supply chain. They are tackling climate risk and supply chain resilience at the same time. The environmental actions, like contracting for renewable energy, are directly linked to securing their supply by supporting their farmers. They're building security from the ground up.
Which brings us to our final provocative thought for you to think about. Given their ambitious net zero goal for 2040, but their short-term struggle to hit that 2025 volume target for non-alcoholic drinks, how much is their future with more cheers still completely reliant on traditional beer sales to fund this huge transformation?
And how quickly do those new biotech and tech investments need to start paying off to really secure that path to diversification? It's the central tension, isn't it? Needing the cash from the old business to build the business of the future.
An excellent point, a fascinating balance of legacy and innovation. Thank you for joining us for this deep dive. Keep exploring those intersections between consumer products and technology.